will have to revalue gold. It's in their piggy bank. It's for an emergency. They should at least revalue it to spot. Will they revalue it a bit higher? We're in a desperate state because we're running out of options. It wouldn't surprise me at all if there's a gold revaluation. So I'm taking it seriously. Can we just suddenly wake up one afternoon and see this announcement that gold's been revalued? Sure, it's possible. Let's not forget 1930s America under FDR. Overnight, you can make gold confiscatable and then reprice it for the government's benefit. And that happened overnight.
I am putting you on the spot here, but if you had to say, do you see this happening in this administration, would that be a yes or would that be a no?
I think if it's going to happen in any administration, would be under this one, and not necessarily for the right reason. A revaluation, it's a confession that we're in debt. It's a confession that our dollar is distrusted and less valuable. It's when we weaponized the dollar in 2022, I said, everything's going to change now. I think what I'm seeing right now is a watershed moment, a kind of convergence of anxiety and desperation, and yet some paradoxical hope.
You've said that this is the first time in modern history that we're seeing stocks, sovereign debt, and fiat currencies all in crisis at once, and that's the difference this time. So explain what you mean by that and explain how this convergence of these three pillars crumbling at once plays out and what that could look like.
This is The Real Story with Michelle Makori.
Thank you for joining us. I'm Michelle Makori, and this is The Real Story, where we go beyond the headlines, beneath the surface, and behind the curtain to show you what is really happening with money, markets, and power. The U.S. national debt is now exceeding $37 trillion, over 120% of GDP, and confidence in the system is cracking. Gold is up more than 40% in the past year, and central banks continue to buy gold at record levels. And now what was once dismissed as monetary conspiracy theory is starting to sound like policy prep. The Federal Reserve may be quietly laying the groundwork for revaluing America's gold reserves. On August 1st, the Federal Reserve released a research note titled Official Reserve Revaluations, the International Experience. It outlines how 5 countries used gains on their official gold holdings to raise funds. Now, the Fed note didn't recommend that the U.S. revalue its gold, but it did lay out in detail how 5 other countries have done it. The Fed report explains how countries like Germany, Italy, Lebanon, and South Africa revalued their gold reserves to raise massive sums of cash without selling a single ounce of gold, raising taxes, or issuing new debt. Now, consider this. The U.S. Treasury still values its reported 261 million ounces of gold at $42.22 per ounce, a number that was set back in 1973. Meanwhile, gold is trading north of $3,400. If that gold is marked to market, the result would be an $880 billion windfall. Nice, but not even enough to cover a year's worth of interest payment on the debt. But the speculation here is that if this happened, it would be revalued at a far higher number. And the fact that the Fed may be floating this revaluing idea is adding fuel to this theory. And this isn't just a fringe theory from the Goldbug crowd. Former Fed advisor and possible nominee for Fed Governor Judy Shelton supports it. Senator Cynthia Lummis introduced legislation to revalue the gold and use the proceeds for a Bitcoin strategic reserve. Treasury Secretary Scott Bessent has said that we're going to monetize the asset side of the U.S. balance sheet. Now, he did walk that back a little in an interview on Bloomberg, but at the same time confirmed that the U.S. gold in Fort Knox was indeed there and all accounted for. And even Donald Trump Jr. says his father's administration is exploring a powerful economic tool under the Gold Reserve Act to reprice America's gold. He outlines how it would be done and said that this would strengthen America's financial position and signal gold's renewed role in the monetary system. Now, granted, he is saying this in his capacity as a spokesperson for a gold company, but it is a strong signal nonetheless. So is a gold revaluation coming? And if so, what does this all mean and what comes next? is this just a symptom or a response to a much bigger systemic problem that could have historical massive consequences? Is this perhaps the start of a monetary reset? Well, joining me now is someone who has been ahead of the curve on this story for years. Matthew Piepenburg is one of the most incisive macro analysts on the collapse of fiat currencies and the decline of US supremacy. Piepenburg is a partner at von Greyerz Gold in Zurich, one of the world's top wealth preservation firms. He's a Harvard-trained attorney, a former hedge fund manager, and an ex-chief investment officer of multi-billion-dollar family offices. He's also the author of Rig to Fail and the co-author of Gold Matters. Matthew, thank you so much for joining us. Excited to speak with you.
Well, Michelle, I'm very glad to be here. It's always a pleasure to exchange thoughts with you, and there's certainly no lack of things to discuss today, as you've noted from the intro.
We have a lot of ground to cover. Gold revaluation, certainly top of that list. That may be happening, but essentially that is just a symptom or a response to a bigger problem, a system that you say is terminally broken. So before we get into gold revaluation, what that means, how that could play out, let's start with your big picture view. Tell me, how are you seeing the world right now? What is your 50,000-foot macro?
Yeah, listen, I mean, there's easy criticism in the gold space. It's a lot of sensationalism, a lot of clickbait, a lot of permanent negativity. And I understand that. And I want to get to the point where we're looking at facts and drawing our own opinions and not just data mining, but data analyzing. I think before we get into very important examples of what I consider desperate reactions, not necessarily effective reactions, you need to put it in the perspective of the world we're all participants in current events, whether they're market events, currency events, geopolitical or military events. Sometimes it helps to put those current events into past perspectives as well. But I think what I'm seeing right now is a watershed moment, a kind of convergence of anxiety and desperation, and yet some paradoxical hope that the S&P and the White House will save us. And I want to look at that objectively as possible without just being negative. But I think in the larger perspective, we're seeing the worst global relations since 1949, probably the greatest financial bubble in the history of capital markets. Uh, I would think the highest geopolitical, military, and nuclear risk since the Cuban Missile Crisis, and probably the lowest trust in Western governance, again, from the G7 to Jerusalem, from DC to Kiev. There's a distrust in leadership that's pretty palpable. We also, of course, have the greatest debt levels in the history of mankind. And as David Hume said in the 1750s, or von Mises centuries later said, debt destroys nations, it destroys peace, it destroys freedoms. And Ernest Hemingway said in the 1940s that when you see debt-soaked nations, you then see the permanent ruin of currency debasement and war. These are certainly important things to consider right now. And I think also the jig is up on paper money, the inherent purchasing power of fiat money. I think electronic money, including stablecoins, which you introduced, which we'll get into more detail, is just another example of that fantasy empirically. And I don't think it's any different. So the world is moving to gold, I think, which we'll obviously get into as well, as kind of a BS detector on these broken things. But I think in this backdrop of so much dysfunction, financial, political, currency, and debt, there's a lot of desperate policies kind of masquerading as evolutions, as energy, as us, as kind of audacity. And it's certainly good to see energy compared to the last administration. And these policies under Biden or certain policies under Trump, to me, weaponizing the world reserve currency, the whole stablecoin CBDC meme, the tariff policies, the External Revenue Service, even the BTF plan during the banking crisis under Biden, this fantasy that the Fed can control rates and money supply like a thermostat, to keep the economy in order. The dysfunctions we're seeing in the comics and the stories we're being told about that, the idea that we should blame the BRICS for our own overspending in the U.S., even the conversation, of course, from Judy Shelton on gold-backed U.S. Treasuries, and now from the Fed and the Treasury on gold revaluation. To me, these are desperate, not exciting signs, and I'll give reasons why. I think in this backdrop, I go back to the history too to put it into context. I mean, we have to, comfort our own assessments. You don't have to take my assessment or Willem Middelkoop's assessment or Luke Groman's assessment or Donald Trump's assessment or Egon von Greyer's assessment. But I think, as John Kennedy said, there is something immoral about abandoning your own judgment. And to trust your own judgment, it has to be informed. Again, it doesn't have to be, overlap with mine, but informed judgment gives us some, I think, peace. And I think informed judgment is very hard though, because it means you have to dig into some rabbit holes, some math, not hard math, and you have to look critically at even your own convictions and biases. And it's very hard in geopolitics and certainly in national politics to have an informed opinion with so much noise. But certainly in economics, it can be very hard to have an informed opinion. John Kenneth Galbraith, who was Kennedy's economic advisor, said that economics really aren't there to reveal truth, but to actually kind of disguise and evade truth. That was his final lesson from economics. And it reminds me of the complexity scheme or scam that I see in the markets from when I was a young idiot in the dot-com bubble to something a little bit more educated in markets through being a veteran. But there is so much intentional complexity, complex plumbing in the markets, whether it's central bank policy, whether it's derivatives and swaps and asset-backed security tranches and rating agencies, whether it's the COMEX and the FX exchanges, or certainly now as we get into the stablecoin or Genius Act oxymoron, there is intentional complexity. So it's very hard for the average man or woman on the street to really make an informed opinion on that. And I think that's, incumbent upon us. And I'll say that great economists, honest economists, whether it was Lord Mervyn King, who's still in the UK today, said economists are always looking to optimize. They're never looking at reality, that everything's optimizable. And as Richard Werner has made very clear in the last few years, these stochastic models that the Fed uses and the economists use to get tenure or to get popularity in the academic or think tank circles, none of their models have brought inflation to 2% in any of the developing economies over the last centuries. So it's breaking away from consensus think to contrarian think without just being nihilistic thinking. I think it's up to each of us. Again, it doesn't mean just taking my views. And I think the real goal for us and for every conversation is to set out the facts as we know them, draw our own conclusions. I will certainly have mine. But I think gold is calling BS on all of these systems, all of these solutions, all of these models, all of these kind of, I don't know, optimization nonsense, this be calm, carry on, as we're looking at the menu on the Titanic. And again, I said many times, deciding between duck, fish, or steak, or red or white wine, when we really should be on the deck looking at the iceberg. And no one wants to see that because it's painful and it's unattractive. And, and I'm not just an iceberg looker. I'm not just looking for icebergs, but, I've been bullish many times in my life, but in the bigger, larger section, you can't help but look at these paradoxes with a cynical eye. And I think a critical eye is really necessary right now, Michelle.
Well, we do have you here for your analysis, and I don't think that even back in your youth, anybody would ever describe you as a young, foolish idiot. I'm sure even then you had a lot of insight. But let's talk about this iceberg that we're heading towards, as you say it, while we're contemplating what's on the menu. You've said that this is the first time in modern history that we're seeing stocks, sovereign debt, and fiat currencies all in crisis at once, and that's the difference this time. So explain what you mean by that, and explain how this convergence of these three pillars crumbling at once plays out and what that could look like.
Yeah, and again, I joke it's the Piepenburg broken record. Always start with debt because I think you can't overstate debt enough. And once you understand just the basic concepts of these debt and the basic math, and it doesn't require a lot more facts, whatever strand you pull on, whether it's currencies, whether it's bond markets, even whether it's foreign policy, and certainly whether it's monetary policy, all of this in the bond market and the stock market, everything does come from the credit market, which is the debt market. So all of these things are connected. All this is verbunden. It's all connected. And again, I go back to these simple things. The day of my birth in the 70s, U.S. debt was 200. Public debt, government debt was 246 billion. And where I am today in my lifetime, we're now at 37 trillion. And that's appalling. And a billion versus a trillion isn't just mathematical and isn't just alphabetical, it's mathematical. As John Rubino reminded me a month or two ago, a billion seconds ago was somewhere around 1997, but a trillion seconds ago was 30,000 BC. So these trillions matter. They're not just abstract numbers you throw out to show what you can memorize. And, global debt, it's not just a U.S. problem. Global debt in 1997, when I started my first hedge fund, was at 30 trillion, and now it's at 300 trillion. That's a hockey puck. It's a rocket ship up and to the right in just the last 25 years. So these aren't things I'm just making up. They're real. And it's not just at the market level or the government level that debt is extreme. Household debt is now 97% debt to income. And so, these are the numbers. And in case you think there's no evidence of how those things break things, you don't have to go back a century. You don't have to go back to FDR. You don't have to go back to 1929. Just in the last 6 to 7 years, it started, and I thought it was completely ignored by the mainstream media and the financial consensus RIA industrial complex. But the 2019 repo crisis was a disaster. It was a credit crisis. It was because of a debt crisis. And just a year later in March, during the COVID hysteria, that was also not a COVID-induced 2020 market plunge. That was a bond market-induced market plunge in 2020 because bonds and stocks fell together in 2020. And just 2 years later, across the pond in the UK, we had the gilt crisis. That was sovereign UK bonds being unloved, undesired, and yields spiking and the cost of debt skyrocketing. The next year in the US, we've already forgotten the headlines. You and I talked about it years back. We had the banking crisis in 2023. 4 of the 5 largest bank failures in U.S. history, forgotten. But that too was not a banking crisis. That was a credit crisis. It was a bond crisis. It was the U.S. Treasuries that were the underlying collateral on those banks. And then you fast forward to just this year, Liberation Day, the tariff, event, markets losing 10 trillion and then recovering when Trump did the two-step. But that wasn't a tariff crisis. That was a U.S. Treasury debt crisis because right after Liberation Day, there were crickets at the U.S. Treasury auctions and massive sell-offs by U.S. owners of U.S. Treasuries, not just Japan and China. So those were all examples of a credit crisis, a debt crisis, and a bond crisis. And they were showing us in real time that we're over our skis in debt. And again, it's not just me finding the evidence. The evidence is all around if you're willing to look for it. And in this debt crisis, we have very few options. We can default, which we won't do. So we'll have to inflate away our debt. And the way we do that is dishonest. Inflating away debt just means you have to have an inflation rate higher than your yield on your 10-year, and so you have negative real rates. That's the fancy term. You just have to inflate away your debt. You debase your currency to do that. But the way we do that so dishonestly and disingenuously is we lie about the inflation rate. We just do. The BLS is a fiction source, not an honest math source. And the CPI scale used to measure that inflation scale has been, changed 22 times since 1980. It's probably closer to 10%. So we're running negative real rates. We're running a debased currency policy. We're running an invisible tax on the people, lower, middle to upper class, to basically pay our debt by debasing the dollar, as von Mises, as David Hume, as even Ernest Hemingway warned, who weren't, all in the same generation. This is Ima Vidas Gleica are always the same. And I think this debt is so powerful that as we talk about stable coins, or we talk about the markets, or we talk about tariffs, or any of these topics that are making current headlines, they're as old as history itself. We're in a desperate state because we're running out of options. And when you get to a debt to GDP level at World War II levels with no war, the emergency isn't war. The emergency is our own overspending and the mismanagement and criminal negligence of our monetary policymakers and our leadership, left or right, because all of these nations and all of these policies and all of these parties, whether it's Democrat or Republican, to me are just two stirrups to the same saddle. They spend more than they can to get short-term dopamine rush for political reasons, not for longer-term thinking.
Okay, a lot to unpack there, but let's begin with, you mentioned the tariffs and you mentioned President Trump, and say what you will about him. He's trying new tactics. He's playing the long game here. And arguably, many would say for the greater good of the country. He's using those aggressive tariffs to rebalance in the U.S.'s favor, but not just as leverage, but as a tool to bring back supply chains, to rebuild U.S. industry, make America less dependent on adversaries. Now, we have already seen several trade deals signed successfully. I believe there's over $2 trillion in foreign investment pledged from countries like Japan, the EU, South Korea. There's been $150 billion already collected in tariff revenue. Treasury Secretary Scott Bessent projecting more, at least $300 billion by year end. I mean, just the other day, even Apple, arguably the poster child for cheaper labor and global supply chains, is now pledging another $100 billion in U.S. manufacturing, bringing its total to $600 billion. Now, granted, this is to secure exemptions from the new chip tariffs, but it's working. I mean, the goal for the Trump administration is to rebuild American industry, protect national
Mhm.
security, regain economic sovereignty, build back the fundamentals of the American economy. Could
Mhm.
Trump's strategy, onshoring manufacturing, taxing imports, reshoring supply chains, could that change things? Could that buy more time? Could this delay the systemic reckoning? Could it even prevent the systemic reckoning that you speak of?
Look, let's be very clear. We have to look at tariffs from the positive and the negative. What you've just listed is a very compelling list of positive things, many of which I agree with. One of the reasons I was supportive of Trump was his larger plan of reshoring American labor, reshoring American jobs. Again, I'm from the Midwest. I've seen the Rust Belt. I've seen what offshoring the American dream to China with the World Trade Organization in 2001 under Clinton. That wasn't really China, becoming a bigger market for our blue jeans and things. It was China basically making our blue jeans and things. That was a misreported kind of new world. And as I've said many times, the American dream is now made in China. So the idea of reshoring manufacturing, putting on tariffs in some strategic way to convince mostly American CEOs to bring labor back to America is absolutely something I agree with. And there's absolutely no denial, whether you're left or right, that whatever you think of Trump, love or hate, or whatever you think of Biden, love or hate, there's certainly more activity in the current administration than there was under Sleepy Joe. That some people take offense to that. Is that activity bold? Is it intelligent? Is it audacious? Or is it stupid? It depends on people's politics, what they think. I think when we answer the question about tariffs, are they good or bad? Are they inflationary or deflationary? Are they fair? Are they effective? Are they legal? And do they even work? You've got to try and step away from a red or blue lens. And again, look at both sides of the argument. And there's a lot to be said to your point. This is a necessary measure, not a desperate measure, a necessary measure to solve an age old problem from 2001 to bring the P back into GDP, bring manufacturing back to America. I completely applaud that. The question is it going to work? Is it effective? Is the External Revenue Service incoming revenue offsetting the loss in GDP? How do we predict and make a prognosis on that? The most obvious bear case on this, or the negative case, is we've seen this for the last couple of months. People talking, of course, about Smoot-Hawley. That tariff act came at the top of a market bubble heading into a recession. It didn't end well for the Senate careers of Smoot and Hawley, and it really didn't end well for McKinley, the president who put those tariffs on. That it was an absolute disaster. Here in Europe, if you read the German press or the French press, or you listen to the economists here, they think this reshoring will take decades, years, whether it's pharma, aluminum, steel, whether it's wood, whether it's intermediary parts. That's their perspective. So even though if you're applauding the nobility of taking the first steps, it won't be solved in the near term for Trump, which maybe he's thinking long beyond his legacy, and that's fantastic. That again is, I think, to be determined. There's also the inflationary or deflationary debate about tariffs and which is better or worse in the short term pain that Bissett and Trump talk about for long term gain. Hypothetically, a 15% tariff pretty much means a 15% price hike. So it means inflation in certain goods. And as many economists will say, inflation creates its own deflation because as prices go up too high because of these protective tariffs, that creates its own deflation because demand falls. And so you get deflation. And you can debate that for hours, and many have, and we'll see. And that maybe sounds like a cop out question, but it hasn't really progressed enough to see whether it's inflationary or deflationary until it really gets into full gear. And then there's also the question of fairness. The anti-Trump camp, and certainly in Europe, where I spend most of my time now, they think it's unfair. A Trump 15% tariff, or a 30% tariff, or negotiating tariff, or a 40% tariff. It depends on the good, whether it's pharma, whether it's aluminum, whether it's steel, whether it's a different asset or a different product. But this kind of negotiation by chaos and these tariffs seem unfair. But I think it's important to remind European listeners as well that the VAT tax, the value added tax that Europe puts on American products, is 20%. It's not a tariff in form or in substance, but it is in form, excuse me, but it really is in substance. And let's also not forget that China built its entire auto sector behind a 25% tariff wall when Japan's tariffs were at zero and the US was at 2.5% and the EU was at 10. So it's not like Trump is the only bully here playing, for national interest. All nations are self-interested, and all nations have used protective tariffs, or you could say weaponized tariffs in the past, to build their own demand inside their own borders. So you can take both sides of this. The real question, to your point, is this effective?
Right.
Will this be effective? And, a Yale professor was just on the other day talking about this. I've seen studies out of Zurich that are very convincing with their models that tariffs, will take at least a percentage point off our GDP near term, for the next few years, versus the revenues we're bringing in on the external revenue service on these tariff deals. We're going to lose growth because despite the long-term play, the long-term gain, the costs and the deficit spending and the production costs and the wage labor effects are going to be very expensive. That's going to hurt our growth. We really can't grow until we get out of debt, and we're trying to grow first without getting rid of that cannonball of debt. You know, that's the key part. That's what Luke Groman and I agree on. You can't fix this. You can't even have these policies until we solve the spending and the debt side of it first. So there's the argument that despite the revenues coming in, the flip side of the growth loss, that too is too early to determine. It's academic and theoretical right now. But we saw what happened on Liberation Day with those tariffs. And that obviously, to me, what that said was when Trump was threatening massive tariffs, like 100% tariffs on China, that was a road too far, a bridge too far. And he had to two-step back on that because demand for U.S. Treasuries really tanked on that type of announcement. The August tariffs, those were more foreseen and baked in. So there's still, in Europe, they talk about there's no legal measures in place. There's no even idea how these are going to be papered. And there's a sense that we don't even know how long they're going to last. And a big argument made in Europe, not saying it's right or wrong, it's just important for all of us to look at different sides. Are these tariffs even legal? They're happening, but they're not under investigation. They're being challenged by 11 different courts right now because Article 1, Section 8 says this is the domain of Congress. So where is Congress in all of these executive orders? In Europe, people are wondering, and in Asia, how long will these executive orders last? How long will they be enforceable? Where is the Congress in this? And there is something either entertaining, horrific, or noble about this type of president who can do these type of executive actions almost to some like a monarch rather than a democratically elected president. Again, that's for each of us to decide for ourselves. But to answer your question, Michelle, it's too soon to tell whether GDP will be offset enough by incoming revenues to solve the problem. My view is, as I said from the very beginning, when you're at 120% debt to GDP, when you're at 37 trillion, when your deficit of spending versus tax receipts went from 1 million to now 2 million this year, these things are effective, the hundreds of billions, the 50 billions. But I hate to say it, and again, I'd say this to a Democrat or Republican, they're a guppy solution to a whale of a debt problem. And to me, going back to my original point, love it or hate it, I think these are desperate acts. It's certainly better than doing nothing. But we are at a point where, again, the Wizard of Oz isn't going to solve this. We're going to have to go through some austerity, some constructive destruction, some mean reversion in the markets if we're really going to admit to ourselves, like we would in a family or a business, that we've spent more than we earn. We're going to have to tighten our belts. We're going to have austerity. We're going to have to cut spending. And where are we going to have to cut spending? The places where the debt to GDP would only be solved is in entitlements and military. And I don't see that happening. So this is where it really becomes a real paradox, regardless of where the S&P is or regardless of what the headlines are. That 37 trillion, that 120% debt to GDP, that bond market being unloved and that de-dollarization that isn't a conspiracy theory is all happening at the same time. That as the debt keeps rising, the bonds keep falling. We're in this desperate phase right now. It doesn't mean the end of the world. It doesn't mean the end of the dollar. But I don't see these as being long-term solutions right now.
All right. On the de-dollarization point, I do want to touch on stable coins, which may create a new market for treasuries. But before we unpack that, let's focus on the measure that we mentioned at the top of the show, which could fall under what you would call a desperate measure, or perhaps a nuclear button, or perhaps exactly what's needed that maybe could save everything. And that's this gold revaluation. Now, you've long suggested that the U.S. could revalue gold. That idea seems to be gaining traction. As I mentioned, we have a note from the Federal Reserve discussing it. Now, this could just be planting the seed, just putting that idea out there. But the Federal Reserve effectively just cracked open the gold revaluation playbook. In that note, the Fed outlines how countries like Germany, Italy, South Africa, and Lebanon tapped gold gains to raise cash without selling a single ounce of gold. And that Fed note reads, with public debt at high levels, so they're acknowledging that, some governments have begun to explore financing additional expenditures without raising taxes while also not increasing public debt outstanding. One possibility is using proceeds from valuation gains on gold reserves, as has been floated in the US and Belgium recently. Now, for the US, this would involve revaluing the government's 261.5 million troy ounces in gold reserves, the largest gold reserves globally, from a statutory price of $42.22 per troy ounce to current market prices, which at the time of reading this stand at around $3,400 per troy ounce. They have it at $3,300, but that just shows you how gold appreciates since this note was written. So again, the note reviews those rare cases when countries use the proceeds from valuation gains on gold and foreign exchange reserves. It does not explicitly say that the U.S. will do this, that the U.S. should do this, but it did lay it out in detail. So how 5 other countries have done it. What do you make of this? Is the Federal Reserve quietly laying the groundwork for revaluing America's gold reserves? Is it planting seeds here? Do you think a gold revaluation could happen?
Well, again, necessity is the mother of invention, and desperation is the mother of good and bad ideas. Usually bad ideas. And look, I'm a gold bug. I'd love to see gold revalued at a higher price than the bid from the Treasuries, so the Fed can push gold up. But before we get to that type of fantasy, that type of clickbait of $20,000 gold by fiat, let's look at the reality of these reports. Let's look at the reality of the ramifications, and let's do our best guessing for each of us to determine on our own. I've been thinking about revaluation for years. That was tinfoil hatted in 2020. Francis Hunt was talking about this years ago too. That was tinfoil hatted. To your point, now it's becoming mainstream. Not surprising, it's becoming mainstream because the debt levels have gotten so exponentially worse. And as far as in the issue, I said at the very beginning, to me, revaluation, just like a gold-backed U.S. Treasury, is a sign of, you could say, sounder money, but it's also a sound of desperation. It's a confession that we're in debt. It's a confession that our dollar is distrusted and less valuable. It's a confession that gold is a far more centralized, central and I think critical asset today than it was treated 10 years ago. So these are all very important for the gold camp. But in terms of the reality of a gold revaluation, this report in August, which I just did a Substack discussion on today, and the one that came out in May, this was a May Fed manual. They're both kind of, you could say, telegraphing in a psyop way or planting the seeds of a possible gold revaluation. And let's think about that. Would it work? These are the reasons. When you read this report, it's very sanguine. Ultimately, the mood is it's a temporary fix only, and we're really not in favor of it. It kind of takes away central bank autonomy. But by the way, Lebanon did it, Curacao did it, Germany did it, Italy did it, etc. And so these are, South Africa did this. These are 5 examples from 1997 to 2024 where countries have revalued their gold reserves to get out of a debt problem. And the question then would be, okay, it's been done. That's them kind of suggesting we're not the only ones going this way. Although I wouldn't, comparing the U.S. to Curacao, St. Martin is kind of sad, or Lebanon is kind of sad. There's a whole other rabbit hole there. But that's how desperate we are. I've said many times we have the balance sheet of a banana republic. But okay, we've got $42.22 certificates. We've got 261 ounces. Some say 287 million ounces. If we revalue at the current spot price, that gives us, just shy of 900 billion. Let's say, for simple good math, obviously, let's say it gives us $1 trillion at the mark-to-market price, which legally on the balance sheet of the Fed and the Treasury, the asset and liability side, that May report says this can be done. So it can be done. And Dissent has said we need to monetize some of our assets and the balance sheet of the Fed. This would obviously be gold. So if we marked gold to market, which is what a Forbes article in February this year said, well, that's $1 trillion. So that helps us a little bit with our, debt to GDP. But again,
it doesn't. It barely covers. It barely covers a year's interest payment on the debt. That's why people are thinking if you're going to do it, you're going to have to revalue it much higher.
Right. And so again, my point was going to be that's a guppy solution to a whale of a problem. Even Doge, as laudable as it was, despite the problems with Elon Musk and Trump, even if Doge had succeeded at its policies, that was still a guppy solution to a whale of a problem. Again, better than nothing. So to your point, what's $1 trillion in this backdrop? And that
Unless you
raises the question,
revalue this higher.
exactly. And so there's speculation that we could, we could put in a bid for $20,000 gold, $15,000 gold, $10,000 gold, even at 20,000 gold. If you're getting 5 to 7 trillion, which is that's a significant dent in the debt to GDP. If we went from 37 to 30 trillion by revaluating gold from an act of fiat at the Treasury and the White House, that would definitely get our debt to GDP at a place where you could argue growth is possible. And you could argue that makes sense. That's not desperate. That's common sense. Let's take those $42 certificates and give them something bigger than market. But then you're creating an entirely new floor for the gold price, which for gold bugs like us would be fantastic. I certainly wouldn't. I should be selling that book all day long. But realistically, you've got to go back to Kissinger's warning about revaluing gold, because this is my opinion. It's only my opinion. It's in the face of the World Gold Council. But my opinion is that China and Russia have significantly more ounces of gold than the US does. And that I cannot back other than with other kind of reports I've read from contrarians who've looked at these producers of gold, how they report their gold, how they store their gold, how their citizens own their gold. It's my opinion that if we revalue gold to 20,000, that would certainly, or 15,000, again, I'm speculating, no one knows. But if we did revalue gold higher, the adage, he who has the most gold wins, would apply. I think that would certainly help us in the near term with basically using gold as QE, because certainly by monetizing gold and repricing gold, that's better than just creating money out of thin air to pay down our debt like we do at the Fed. If we monetize and revalue gold to pay down our debt, it's 7 trillion or 5 trillion, depending on where we revalued it at. That would be a short-term boon for the US, for sure. That would bring our debt down significantly. But then in terms of our global leverage, and this is what Kissinger warned about many years ago, well, then what is China and Russia with their own exchanges in St. Petersburg and Shanghai? You think they're going to float a gold price at spot today? If we go to 20 or 15,000, they're going to price it more fairly, and they're going to have, I think, more ounces of us and therefore more leverage with their currency and with their trade than us. That's my view. Again, take it or leave it. Some would disagree. But I think the tone right now of these May reports and August reports is it's still, to me, a long shot that they would revalue higher than spot. But on the flip side of that, let's not forget 1930s America under FDR. Overnight, you can make gold confiscatable and then reprice it for the government's benefit. And that happened overnight. Let's not forget 1971, literally 54 years ago this month, when Nixon just got on the phone and said, this is a temporary measure. We're going to decouple from gold. It's going to be very temporary. And your dollar will be worth just as much tomorrow as today. Again, we know that the dollar's lost 99% of its value against gold since that famous lie. But is America under Trump, is this the Nixon America or the FDR America? Can we just suddenly wake up one afternoon and see this announcement that gold's been revalued? Sure, it's possible. Is it likely? Who am I to say? I would certainly love to see gold revalued as a gold owner. But right now, based on the tone of these reports and the message, it's very hard to determine. It wouldn't surprise me at all if there's a gold revaluation. I just wrote 2 articles on it. So I'm taking it seriously, but I've got to hedge my own bias. I've got to hedge my own kind of sensationalism here. None of us really know. Bassett has talked about it. At the very least, I would not be shocked to see gold revalued at spot at the market, mark to market. But the question is, to your point, Michelle, is that really much of a help? We'll see. And unfortunately, that's all I can say is we'll see.
Well, that does bring up the question of what that signals about the dollar if the US does go ahead and make this move,
Sure.
if that signals lack of confidence and faith in the dollar. But I do want to focus a bit more on this buzz that this is getting, because it is interesting that this was some fringe theory by gold bugs.
Yeah.
And it's really becoming more of a mainstream idea. And again, what I was saying to one of my previous guests is that if we've learned anything the last couple of years, is that conspiracy theories and facts and reality, sometimes it's just a little bit of time in between before a conspiracy theory becomes an established fact. And look, we did have former Fed advisor Judy Shelton supporting it. She told Andy Schechtman that she expects Trump to issue a gold-linked Treasury bond next year to commemorate the 250-year anniversary of the U.S. on July 4th. Senator Cynthia Lummis, she's introduced legislation to revalue the gold. She wants to use those proceeds for a Bitcoin strategic reserve, but that's the legislation that is in there. You mentioned Secretary of the Treasury, Scott Bessent. He said in early February, we're going to monetize the asset side of the U.S. balance sheet for the American people. There'll be a combination of liquid assets, assets that we have in this country, as we work to bring them out for the American people. I mean, I don't know, what could those assets be? We've got some land. We've got some, student debt. It's mostly, it's mostly the gold. Now, to be fair, he did walk that back in an interview on Bloomberg. But on that same interview, he was very adamant to confirm that, yes, all the gold that we say is in Fort Knox is indeed there and accounted for. That's after Elon Musk was calling for a gold audit. And Bessent has made a lot of interesting comments about gold, more so than I think previous Treasury secretaries. He spoke on Tucker Carlson, made a very interesting comment how gold cannot have a gigantic budget deficit, how gold cannot have a war. I think we have that clip and we can play that.
Gold can't have a fiscal problem. Gold cannot have a gigantic budget deficit. Gold cannot have a war. So just the fact that it is this isolated thing makes it very interesting. And the fact that the entire global trading system, until Richard Nixon took us off, was tied to gold. When I had my fund, I think people might have called me a gold bug.
Right. I mean, there he says it. Gold bug running the Treasury. He's also said in the past, we're going to have some kind of a grand global economic reordering. I'd like to be part of it. I've studied this. I would like to be part of Bretton Woods type realignments. That was on the capital allocators.
I also felt
podcast.
very strongly that we're in the midst of a great realignment, kind of a Bretton Woods realignment coming in terms of global policy, global trade. There's a lot of what I taught at Yale. I've been studying my whole life. I'd like to be part of it, either on the inside or the out.
I don't know. I mean, Matthew, it's some very compelling sound bites. And again, we've got the president's own son, Donald Trump Jr., saying that his father's administration may revalue the gold. Now, granted, he is saying this in a gold ad. He's saying this in the capacity of a paid spokesperson for a gold company. But here is what the ad says in his own words. Patriot, did you know the U.S. government has the legal power to change the price of gold with a stroke of a pen? He goes on to say, my father's administration is exploring a powerful economic tool, the Gold Reserve Act. This law gives the Treasury the authority to revalue America's gold reserves on the national balance sheet from their outdated book value of $42 to current market prices. Why would my father's administration do this? It would immediately strengthen America's financial position, signal gold's renewed importance in our monetary system, prepare America for a new era of sound money principles. We've also got Steve Bannon now encouraging President Trump to tap Judy Shelton for the Federal Reserve governorship seat that's apparently available now. So again, I'm not pushing this theory, but it does seem that this is gaining a lot of traction, a lot of buzz, which a year ago would have been laughable. We have seen the Trump administration very open to new tactics and new approaches, very keen to address what it sees are long-term problems, even if it means some short-term pain. For the long-term greater good, we have seen this. I guess, again, the likelihood, and I am putting you on the spot here, but if you had to say, do you see this happening in this administration, would that be a yes or would that be a no?
I think if it's going to happen in any administration, would be under this one, and not necessarily for the right reasons. You make a lot of different points in these sound bites and in your intro, because first of all, it is very true. The things that were conspiracy theories and quacky just a year ago are now at the mainstream. Is that a good or bad thing? Is that an audacious thing or a smart thing? When I was talking about a gold revaluation, or Francis Hunt was 4 years ago, that was crazy. When I was talking about the dollar moving away from the petrodollar. That was crazy. Now that's happening in real time. When I wrote and again, I'm not just saying this, I was not alone in this. Many said this. When we weaponized the dollar in 2022, I said everything's going to change now. Demand for the US dollar, trust in the US dollar, stacking the gold by central banks, the empirical evidence of that, sovereign wealth funds, the decline in the demand for the dollar, the faults in the milkshake there under Brent Johnson, despite euro dollar and SWIFT and derivative demand, what he's missing is US Treasury demand is going to fail. So all these things happen and gold becomes more and more powerful. I think these theories miss, and what you're saying is very true. The role of gold, whether it's Shelton's US Treasury, gold-backed US Treasury, which has a lot of constitutional law attempts in the past that failed, and we can talk, I've written about that extensively. But the fact that we're talking about a gold-backed US Treasury or even thinking about a gold revaluation to market or higher is the first thing we can all agree on is it shows that gold is now far more central to the conversation of sound money. Bretton Woods 2.0, which the Senate has been talking about for months, Bretton Woods came after World War II after a disaster. I've been saying for years, and again, not alone, that we're going to have, as the IMF projected during the COVID hysteria, they announced a Bretton Woods 2.0. You go to their website, it's literally called Bretton Woods 2.0. And the graph they show, and I can send it to you, literally has gold at the foundation of that new central bank digital currency reaction to the debt crisis, which they blamed exclusively on COVID, but it was entirely the fault of central banks and policymakers and credit issuers. So your first point is gold is now no longer the fringe, pet rock, kooky asset. And that, again, is regardless of whether you're a gold bug, you could be a Yale professor or Treasury Secretary Treasury and be saying this out loud. You can be the president and saying this out loud. You can be Shelton and saying this out loud. We're going well past the DXY up or down debate, gold inflationary, deflationary debate, gold is a pet rock debate. We're now seeing gold from central banks to private wealth managers, to sovereign wealth funds, to politicians and central bankers talking about gold as central to their thesis. But again, when you look at the report that just came out, to answer your question, will they actually, revalue gold or revalue these certificates? I think they will revalue the certificates to answer your question. Will they revalue 42 to 3,400, 3,500 gold? Or will they revalue it to something where they set a new bid and create a new floor for gold? That is a stretch. That is certainly possible. It's no less likely than Nixon decoupling in 71. So who am I to say? But if you read that report, even the central bankers themselves, because we're worried about their independence, said, if we did that, and they were talking about mark to market, maybe not even going to a higher bid, they said this may not address larger structural issues. And what they're saying is, and this is where I think I hate to say it, I actually agree with these central bankers, of which I'm no fan. Even if we did a 20,000 floor, which we could, I'm not saying it's impossible, and we got trillions more in QE through gold, and we brought our debt to GDP down, that is still, in their mind, just a temporary fix from these larger structural problems, they call it. And those larger structural problems are still, even if we got massive QE out of gold, revaluing gold, we still were looking at 30 or 35, depending in the next year's spending. We're still only buying a little bit of time before we're right back on that crack addiction to more debt, more deficit spending, which will come from reshoring jobs because we're going to have some short-term pain or shorter, longer-term pain. This is one way to solve that problem. And this is one way, if we have a gold-backed 10-year treasury or a gold-backed treasury option, of bringing gold back into the forefront, paying down some of our debt, and confessing that our dollar and U.S. Treasury is no longer as respected as it was pre-2022. So this is all evidence of the things you and I have been talking about. And you say you're putting me on the spot. I think they will have to revalue gold. It's in their piggy bank. It's for an emergency. They should at least revalue it to spot. Will they revalue it a bit higher? Again, that would be great for America's debt, as Trump Jr. says. But what we're going to go back to my Kissinger warning. If you revalue gold and create a new gold floor in the U.S. and trade it on the COMEX in London at a new price, you have to ask yourself, in the global context, if we're so worried about Russia and China, and that's a personal decision, certainly is on the minds of our central bankers and our policymakers in DC, you have to say, does China really only have a few thousand tons? Does Russia only have a few thousand tons? In other words, or do they have a lot more than the U.S.? We had 9,000 tons in 71. Now we have about 8,000 tons. Is that accurate? They're saying it is. It could be more, it could be less. My opinion, and it's just my opinion, is that Russia and China have more. And so that goes right back to that question. So yes, gold revaluation higher than spot certainly helps our debt, certainly creates new liquidity for a very dry, illiquid market, which is on the teetering of risk. And it would help America in the short term, but be careful what you ask for, because there are other countries that own gold too. And what would England do? What would England's position be after Brown sold all its gold at 270 in 1981? So these are things that are more out there than just these two reports and some quotes online. But as a gold bug, of course, I'd love to say absolutely it's coming, and I'll be happy to see it come. But I can't say with straight confidence that that's a smart decision.
Right. Look, 2 points to unpack there. But let's begin with what you're saying would be the reaction. That you're going off the premise that China and or Russia have more gold than the U.S.
Possibly.
Some officially on record, the U.S. has the most gold. Some people question that, saying that Fort Knox hasn't been audited. Maybe the gold isn't even there. Maybe the gold has been rehypothecated. Other people, Edward Dowd came on the show. He said he thinks Fort Knox has more gold because he points to Saddam Hussein's gold, Gaddafi's gold, some Ukrainian gold. A conspiracy theory, but he's a contrarian. He thinks we probably have more gold. Andy Schechtman believes that the U.S. has been secretly buying gold through a covert shadow program, and he points to the fact that the U.S. has become a net importer of gold. I believe just this year alone, 720 tons of gold have made it into the U.S., according to the COMEX. So there are some debates as to whether the U.S. is the top gold holder or not. But either way, the U.S. currently enjoys the exorbitant privilege of being the global reserve currency, irrespective of gold. You've mentioned de-dollarization and weaponizing the dollar and people losing faith in the dollar. Would revaluing gold signal that the U.S. no longer has confidence in the dollar itself? Does this accelerate de-dollarization? What kind of message would that send?
Again, exactly, Michelle. This is a confession. And I'm all in favor if they do it as a gold owner, as a physical gold owner. I'd love to see them revalue gold at a much higher price floor, because that's fantastic for my bottom line. But stepping back from my personal self-interest and bias, this is a sign that we are desperate. We are in debt. We can't keep QEing to the moon. We can't keep mouse clicking zeros and creating money ex nihilo out of nothing to monetize our debt, because we're losing credibility for our own debt, our own IOUs, our own US treasuries. We're losing credibility for our US dollar. And that de-dollarization theme wasn't just because America was debt over its skis in debt and less trusted just because of the level of its debt, but also because we weaponized that dollar. We froze the FX reserves of a major nuclear power already in allegiance and trade alliances with China. We put China and Russia closer together, not further apart. It was an absolute disaster. I've said, and many others, it was one of the worst decisions we made. But the de-dollarization that came subsequent to the weaponization of the dollar and the rise of the BRICS is no coincidence. And to your other point, this de-dollarization, which is not a conspiracy theory, it's a very strong reality. And the rise of the BRICS is a very strong reality. And the selling of dollars or oil outside the petrodollar, the Russia yuan sale of oil in China, these are all massive things. But to your point, if we do revalue gold at price, market or higher, that is a confession that our dollar and our treasury is not enough to get us out of this debt crisis. There's not enough demand, and we can't keep printing and keep the credibility. So we're going to that old pet rock, the old reliable that gets the last laugh in a crisis. I think it is, again, to my original point, a desperate sign, a temporarily effective sign. Even this new white paper that you're talking about from the Fed, it is, they say, just a quick fix, and it won't fix the larger structural issues, but it certainly would be the type of dopamine rush that the politicians like. It certainly will help in the short term, but it is a confession that our dollar and treasury is not enough to inflate our way out of this debt crisis without losing more credibility for that dollar and that US treasury, which is empirically and objectively losing value since 2022. Again, Andy knows this, the COMEX flows know this, the BIS has made gold a tier one asset. Average central bank purchases per year by central banks were at 118 tons in pre-2022. Post the weaponization, that went to 290 tons. So what we're seeing with central bank stacking, what we're seeing with the BIS, the mother bank, the dark star of all central banks, giving it tier one status as of July 1st, what we're seeing with the BRICS de-dollarization, what we're seeing with the petrodollar, what we're seeing with the repatriation of gold, certainly what we're seeing with the COMEX disaster and the float rates in gold and silver are all proof, not gold bug proof, objective proof that nations and sovereign wealth funds and high net worths and counterparties and commercial banks want physical gold more than they want US treasuries and US dollars. And that's what we've been warning for years. And now even Trump and even Bessent possibly want to do something with their gold. Great, it may help. But what we're really seeing, Michelle, what this really is a symptom of is gold becoming central to the solution. This is not a gold backed dollar. This is not a gold backed stable US dollar. This is just gold in the piggy bank that we can revalue as a desperate proof that we're so broke, we'll try this. And to your point, we may have more gold. There are US trusts at Sullivan and Cromwell, New York, that we don't know the names of. Maybe they stole gold from China or Japan after Japan pillaged China. I don't know. That's a Tom Clancy novel. It could be much more than 8,000 tons, could be less. But I do think, from talking to Alistair McLeod and others, and based on what supply and demand forces and the fact that Russia and China are major producers and their citizens and bankers are holding, I think China and Russia have more. Do I know the exact amount? No, I don't. But it will be very destabilizing. So there is a lot of strings to pull on this revaluation point, is what I'm trying to say, Michelle. But it is a symptom that the dollar isn't the dollar it was 10 years ago, and certainly not what it was pre-weaponization in 2022.